welcome to the latest episode of our PwC Risk and Regulation News channel. Today we want to have a look with you at the latest developments with regards to the EU's banking package. My name is Stefan Röth, I'm a director with PwC here in Germany, and today I'm joined by my colleague
Marius Schütte-Mattler, Senior Manager here at PwC.
I'm sure you have already heard the great news that at the end of June, on the 19th to be specific, the EU banking package finally made its way into the EU's official journal. So now we finally do have the legal texts of CRR3 and CRD6 in its final form. Entry into force is a matter of a few days now, and the applicability of CRR3 will be from the 1st of January 2025, as was expected. So all the work that has been going on, at least since the end of 2021, now has finally come to an end, and we are here and we do have access to the final texts in all of the EU's official languages. Now, at this point in time, we would like to use the opportunity to have one more look at the content and the challenges that go along with these new requirements. And as you can see on this here slide, we have once again listed the major components of the EU banking package, the CRR3 and the CRD6. And we have also listed here the key elements, which are, of course, the implementation of Basel III and the finalisation of Basel III in EU law, the topic of sustainability, climate and environmental risks that will influence all three pillars of the Basel framework, the minimum capital requirements, risk management, and also, of course, disclosure. And finally, the CRD6 in particular attempts to further harmonize banking supervisory practices and tools within the European Union. And as always, having a couple of hundred pages of legal texts of course is not enough. There is no less than 139 mandates for the EBA to develop further ITSs, RTSs, opinions and guidelines in the coming years. Having a look at the timeline, and you can see we already have quite a lot of these points covered by now with the publication in the official journal at the end of June. And now what lies in front of us is the entry into force in the beginning of 2025 and the first reporting date that will be by the end of March in 2025. But of course, the EU would not be the EU if there wasn't any changes.
You're absolutely right, Stefan. And there are two major recent changes that I would like to touch on today. First, the FRTB postponement. Since the beginning of the consultation process, CRR3 has included a crucial clause. You find it in Article 461A, which allows for the postponement or adjustment of market risk regulations for determining own funds. This is an effort to harmonize the regulations with international initiatives. And now the EU is making use of this possibility to ensure a harmonized approach from an international perspective. So why is the EU opting for this postponement, you could ask? Well, the main concern is that European institutions might find themselves at a disadvantage compared to their international peers, especially those in the US and UK, if they proceed with the application of the FRTB capital requirements. So banks and politicians have raised concerns during the process of consultation, pointing out to the delayed implementation of other jurisdictions. And well, this lack of action could lead to unfair competitive conditions in the global securities business. The first non-public draft of the legal act has been shared recently, with finalisation expected by end of July 2024. And the overarching goal is to continue with the current market risk methods until January 1st, 2026. Well, this postponement has several implications shown on this slide. First, reporting and disclosure. The proposal foresees that the currently valid reporting and disclosure requirements, as well as templates, should be continued until January 1st, 2026, with maybe just one exception in regard with the FRTB standardized approach disclosure. Second, the floor calculation. For IMA institutions, the idea is that this will be based on IMA approach and the old standardized approach versus the FRTB standardized approach. So there is no need for IMA banks to develop a full old standardized approach calculation for just 1 year. So this is also, in my view, a big relief for the institutions in terms of operational efforts. Finally, there are other topics. For issues like the trading book boundary, the EBA will develop a proposal for further action because it is not reflected in the mandate of Article 461A in CRR3. So I guess we will see a no-action letter maybe in the future that handles those other topics. So that's, in a nutshell, news regarding FRTB. But there is a big second point, the finalization of the main reporting requirements. On July 9th, the EBA has published the final ITS on reporting, along with related disclosure information. They have cleared up and finalized many details of the reporting package, but there are two key changes that really stand out. First, the remittance period. Many stakeholders were worried about the tight timeline for implementing the new reporting requirements. While the application of the new requirements officially kick in on January 1st, 2025, the EBA has responded to these concerns by extending the deadline for the first reporting reference date, which is March 31st, 2025. Originally, the remittance date was set for May 12th, but it's now pushed back to the end of June 2025. That's an extra 6 weeks that banks will get to finish up their first CRR3 reporting. Secondly, crypto assets. The final report now includes reporting requirement on crypto assets, which weren't in the consultation paper. Well, if you look closer to the requirements, you'll see that they are limited to the transitional prudential treatment of institutions' exposure to crypto assets, and therefore limits the reporting efforts in this regard for institutions. However, there are still some other reporting requirements outstanding, like those for operational risk or ESG, which will be finalized in a separate ITS. So, what's next? During the fourth quarter of this year, the EBA will publish a technical package. This will include the data point model, validation rules, taxonomy that institutions and reporting software providers will need to implement and operationalize the supervisory reporting, and also enable institutions to report the CRR informations to supervisors in 2025.
Stefan, you have mentioned the quite hard work of EBA, working on the mandates, having this clear plan how to approach the different mandates reports. Nevertheless, what we observe really in the market and observe looking at institutions working on the implementation of the CRR3 framework, there are some very tricky questions about certain concepts that have not been mandated by EBA to be more clarified. We just pushed up some of those questions regarding the standardized approach for credit risk here on the slide, to illustrate a little bit about what questions, what decisions institutions need to make now in these days to really allow the reporting capacity in 2025. For instance, starting maybe with the first point regarding credit risk standardized approach, the new exposure class for subordinated debt. There is this reference to TLAC, or also MREL requirement, Article 72B, which leads to the fact, depending on how you interpret the legal text, whether there is also the necessity to include a senior preferred debt, so originally non-subordinated debt into this exposure class, or the question if the EU and the supervisor really wants to have a focus on subordinated debt, so only including non-senior preferred debt in this exposure class. And also related questions, for instance, if you look to structural subordination, which is not directly mentioned in the CRR text, however, would maybe from an economical perspective make sense to include. A second example here on this slide is maybe the calculation of property value. So as we know, property value is a new concept introduced by CRR3 to harmonize the different approaches of how to value really immovable property securities, so coming from concepts like market value, mortgage lending value. However, the tricky part for the property value is that there is limited information on how institutions really come up with it. And that is a question that I observe in the market is heavily discussed at the moment to see whether institutions need to find their own way to define the property value, or if there is additional guidance by the supervisor or different associations on how to calculate a property value. Maybe a third example from my side is regarding the due diligence requirements, also a new concept introduced by CRR3 related to the use of external ratings within the credit risk standardized approach. There's also limited guidance on how to approach this due diligence requirement. There are certain trends, especially from institutions using the IRB approach. However, what we observe is really that smaller banks, banks that are using the credit risk standardized approach, are currently in discussions on how to efficiently tackle this new requirement. Maybe a few last words on the last two puzzles here on this slide. We have a new requirement for unrated institutions that is driven by the fact that you cannot use the country rating anymore for unrated institutions. So quite complex approaches introduced, which is taking into account qualitative risk management aspects as well as quite some extensive quantitative data. And that is something that we see institutions are also at the moment struggling a little bit with. And then also the question for institutions that are currently not publicly disclose informations which would be needed by other institutions to really fulfill this new approach. There might be some movements in the market which will lead to the fact that the transparency, the granularity of data that is shared with the market is increasing. And last but not least, maybe an example which relates to some unclarity about definitions. We have this new concept when you look into immovable property secured exposure of ADC, which stands for acquisition, development and construction, which is a little bit tricky because the definition is quite open, focusing on corporates and SPVs financing acquisition, development and constructions. And often institutions first of all think about this speculative immovable property financing that we know from the high risk exposure class in current CRR. However, when it comes to this intention of sale and making a profit, this is something that is not foreseen in this new definition of ADC. So we are discussing with clients whether or how wide or narrow this definition should be really. And if you think about a corporate that is financing its warehouse for its own use, it really pops up in your mind probably. Whether this is acquisition, development, construction, if there is now compared to current regulation a higher risk, and if it's intended by the supervisor that in the future you will need to apply a higher risk weight because you will allocate this exposure in this class or subclass of ADC. So Stefan, as you see, quite some challenges still in the market at the moment. And quite some exciting weeks ahead, of course, in the different implementation journeys of our clients.
And challenges is indeed the right word here if we also look at the capital impact. You know, a lot has been said about the probable capital impact of the Basel III rules on the banks. And we have repeated time and again how important it is to calculate them on an institution-specific level, because we have seen times and again that the impact will vary by bank. But there are some common themes that we have witnessed time and again, and the most important of which was also clarified and confirmed by the EBA's report on the Basel III monitoring, where that on the one hand side, larger banks subject to the output floor will be hit hardest, and indeed quite a lot more than smaller banks that only rely on standardized approaches. And the second important message is that the transitional rules, which have been agreed at the level of EU, push a lot of this pain into the far future, up to the year 2032, when we will have, and you can see it on this slide here, a real cliff effect when the transitional provisions run out and the real impact of CRR3 will be felt, in particular by banks that rely on internal models.
Yeah, that's an extremely interesting fact that we see here with regard to the phase-in and transitional rules. And if you follow this channel for a little bit longer, you will not be surprised because we have mentioned this, of course, since the beginning of Basel IV, and since the beginning we have talked about this topic, that Basel IV, the CRR3 requirements really hit institutions in different ways depending on their portfolio, depending on their business models. And what we observe is that, of course, in the last weeks, months, institutions were quite heavily focusing on the implementation efforts. But now coming or seeing this coming to an end, institutions start to ask strategic questions with the phase-in and the floor requirements taking effect maybe in 1 year or 2 years. This question about the optimal portfolio structure under the CRR3 framework really rises. And that motivated us to come up with a RWA floor simulation tool that allows institutions on the one hand side to calculate based on their granular data, on their portfolio data, the RWA and floor effects for their portfolio, also in a multi-period perspective. When you think about capital planning purposes, this is quite important. Nevertheless, it also allows institutions to identify non-optimal portfolios. And that is really, in my view, the benefit and the great advantage of this tool that I would like to present to you here at the moment, that you can find portfolios that are in this complex environment of standardized approach calculations, internal model approach calculations, not optimal. So this relates, for instance, to securitization aspects, where you find out, for instance, that your securitization, which was done under IRB approach, is not as beneficial anymore, or also to portfolios where you just see the cliff effects of the benefits of an IRB approach is not as beneficial anymore when you calculate or need to calculate the standardized approach. And the tool can identify these portfolios. For some portfolios, you maybe cannot do a lot because you just did this trade. However, it identifies also distribution channels for portfolios where you can do something, where you can do a redistribution, where you can do maybe a securitization, a syndication, or where you can just need or would beneficially sell this portfolio because it's just not worth anymore when it comes to capital requirements. So if you are interested about more the strategic look, more the perspective into 1 or 2 years, please feel free to approach us. We are happy to share a little bit more about this tool, about its capabilities, and also look how this tool can help you really for the future, for your capital optimal planning under the CRR3 rules.
Yeah, thank you very much. And I think this tool perfectly completes our whole range of thought leadership pieces that we have here one more time on this here slide, where you can access the knowledge that we have gained over the last couple of years, supporting a number of clients with their CRR3 implementation, and also with test calculations or optimization strategy identification based on the tool that Marius just presented. We are more than happy to share these with you. And of course, always feel free to reach out to us to discuss the last and final CRR3 texts. Don't ask us for a consolidated version. We don't have it yet, but as soon as we have it, we'll let you know. And in the meantime, we wish you all a lot of success with your implementation projects. Thank you.
Thanks.